So we had the 25 basis points cut call going into the meeting. The market had taken the cut out almost. Look, our sense is that this is likely the end of the cycle, and the governor, as you pointed out, has moved towards financial conditions easing through liquidity measures, both the OMO, 1 trillion INR worth of OMO purchase, and the FX buy-sell swap worth $5 billion. The situation where we think that they can get more dovish is if growth surprises a little bit on the downside going into next year. That can open up room. But on inflation, it seems to us that this was likely the bottom. You're going up towards 3% in the next quarter and likely towards 4% in the quarter after that. So really the room to ease from inflation in particular will be relatively limited.
Okay. I also want to draw your attention to one other comment that was made during the press conference. And there's obviously the difference between what he said when he announced the rate cut and then the written commentary that we've got and the press conference. He said in the press conference to a question that going forward due to benign inflation, we expect it to be lower. And we expect the policy rates to be low and not high. Would it be too much of an interpretation to think that he's suggesting that, yeah, we're open to more rate cuts?
Amitoj, our interpretation of that statement was that it means more likely lower for longer, rather than getting into the market pricing a rate hike anytime soon. I think in our mind also the rate hike is off the table, at least for the next few quarters. And that statement for us indicated that they would want to hold at least at 5 quarter, which is what the current repo rate is, for the foreseeable future, and concentrate on the transmission, as I'm saying, of rates fully through.
Yeah, I understand. Thanks so much. I just want clarity on that. Now, you also said that this is conditional on low growth surprise. If there is lower growth data that comes in the coming year, coming months, and remember that is possible because the new base calculation of GDP is coming in February. So most likely that will be lower in some context. Can you make that connection that there will be lower growth rate because of the base, and then as a result of that, the RBI will further cut?
More than the base change, our view is that you had a front-loading of growth due to exports to the US. Some production front-loading had also happened. As we speak in this quarter, you're having the current account widen, and you've seen the trade deficit numbers being wider than what it was in the previous quarter, due to mainly 2 reasons. 1, lower export to the US, and 2, also gold imports being quite high. For instance, if the trade deal is pushed out into Q1, our base case still remains that you get some announcement by the end of the year. But if that gets pushed out to Q1, you're still having that additional tariff on the MSME sectors, which might be a headwind for growth for the near term. Those are the cases in which our sense is that the RBI will be willing to ease further and quickly. Whereas if it is completely based on inflation, our sense is that it's going to take them slightly longer, because our analysis suggests that the RBI looks at their 12-month forward inflation forecast. And if their 12-month forward inflation forecast comes down, which could be due to multiple factors, for instance, commodity prices lower, or China overcapacity-led deflation spreading into more of the regional inflation numbers, those are the situations in which the RBI can ease on inflation, but that will take slightly longer.